Welcome back, folks. Before we begin covering the final sections, part 7 through 10, I would like to make a brief observation. Some, or perhaps many, of you may find certain concepts intellectually demanding. However, I encourage you to stay with me in the process. I have made every effort to present these topics in simplest, most structured, and easy to understand manner possible while preserving their technical accuracy. True mastery of technical market is not achieved overnight. It is developed through patience, consistent study, and deliberate practice. If you don't grasp everything on the first attempt, that's perfectly normal. Revisit the material, take notes, and allow your understanding to evolve over time. Once we complete this ICT series, my next objective is to launch an advanced lecture series covering smart money concepts and smart money techniques before we move into those advanced topics. However, I plan to publish a number of practical strategy-based videos that are straightforward, actionable, and accessible to traders of all experience levels. My goal is to ensure that every learner, whether a beginner or an advanced market participant, can drive meaningful value, build confidence, and progressively develop the skills required for long-term success. Now, with that said, let's move on the final and most important part of this series, part 7 through 10. It's about crypto, the loved one. No verified record of a dedicated ICT Bitcoin, Ethereum crypto teaching series was found in this research. Secondary sources are split. Several broker or educator blogs claim ICT concepts work on crypto and describe adapting order blocks, fair value gaps to Bitcoin and the Ethereum charts. These are third-party adaptations, not ICT's own teaching. No source produced a direct Huddleston's quote endorsing or teaching crypto specifically. Why traders report success applying ICT to crypto anyway? Independent reasoning. Bitcoin and Ethereum on major exchanges are liquid, two-sided, institutional participated markets, specifically since the rise of spot ETFs and large derivatives volume. So the same generic liquidity imbalance mechanic described in part 2 are structurally present. The commonly cited caveats from secondary sources: wider stops needed, less reliable on small cap altcoins with thin institutional participation, more news fundamental override risk are reasonable extensions of ordinary liquidity logic, not ICT specific claims. Are ICT concepts asset specific? Before we conclude, let's answer one of the most common questions. Are ICT concepts limited to specific markets, or can they be applied universally? Based on the best available evidence, ICT originally demonstrated most of these concepts using Forex and index futures. However, the underlying principles such as liquidity, order blocks, fair value gaps, market structure shifts, OTE, PO3, breaker blocks, daily buyers, and Judas swing are presented as universally applicable across financial markets, provided there is sufficient liquidity and institutional participation. There are a few exceptions. SMT divergence requires two correlated instruments, while CISD is a newer concept with less independent validation. IPDA is the concept most closely tied to the interbank Forex market, although it has since been extended to other asset classes. The key takeaway is this: ICT concepts are not designed for just one market. Their effectiveness depends less on the asset itself and more on understanding market structure, liquidity, and institutional behavior. Always remember that different markets have different characteristics, so proper adaptation is essential rather than applying every concept mechanically. One of the biggest misconceptions within the trading community is that ICT concepts are exclusive to a single market or trading environment. However, based on the available evidence, that's simply not the case. ICT has taught these principles across Forex, index futures, and other liquid markets, emphasizing that the methodology is built on universal price delivery rather than a specific asset class. Likewise, claims that ICT only works on Euro USD only during the New York session or requires professional futures data are not supported by the broader body of available material. While adapting these concepts to highly volatile markets like cryptocurrencies may require additional caution, the underlying principles remain consistent. As always, separate verified information from community myths and avoid repeating claims that cannot be independently substantiated. As we conclude this research, the overall evidence suggests that ICT concepts were most likely developed from institutional futures and interbank market principles before being popularized through the Forex market. Today, ICT predominantly teaches using Nasdaq NQ and S&P 500 ES futures alongside major Forex pairs such as Euro USD, GBP USD, and Gold XAUUSD. The methodology is best suited to liquid, institutionally traded markets where price delivery and liquidity are most consistent. For beginners, Euro USD or GBP USD offer an accessible starting point, while traders with access to futures markets may benefit from focusing on NQ or ES. Advanced traders often gravitate toward index futures due to their clearer institutional order flow and opportunities to apply concepts such as SMT divergence. Finally, it's important to acknowledge a limitation of this research. While every effort has been made to rely on the best available evidence, I was unable to verify every point directly from ICT's original video timestamps. Therefore, some conclusions are based on converging secondary sources and logical inference rather than primary source citations. As always, continue your research, think critically, and verify information from original sources whenever possible.